So what does a professional, high-stakes trade actually look like? Today, we are going to get under the hood of a super detailed trading blueprint for one of AI's key players, Micron Technology. And we're not just going to look at a stock chart. We're going to dissect the whole strategy, the psychology, and the discipline behind a major market play. And right up front, we've got to put up the mandatory but super crucial disclaimer. We are breaking this whole thing down for educational purposes, okay? This is all about the process and the planning. It's not a recommendation. You've always got to do your own research. Okay, so right at the heart of this entire setup, there's this huge conflict. On one hand, you have Micron, which this analysis says is an incredibly cheap AI stock about to hit a profit supercycle. But on the other hand, it's swimming in a market just filled with fear, and its own chart, well, it doesn't look so great. You've got the fundamental strength, the company's powerful story and its financials rated a massive 9 out of 10. But the technical picture, the chart, the current market vibe, is a shaky 5 out of 10. The whole trade really hinges on which one of these two opposing forces is going to win out.
So just as a quick refresher, halal investing basically means screening companies to make sure they aren't profiting from prohibited industries or carrying excessive debt. First, let's look at their core business. Micron manufactures semiconductor memory chips. This easily passes the initial compliance check. Second, we've got to talk about debt. So what do the numbers look like for Micron? Well, they're sitting on $11.8 billion in debt against a massive $451 billion market cap. That brings their ratio to a mere 2.6%, meaning they clear the requirement by an absolute mile. Finally, we have to look at interest income. Theirs is virtually negligible, which easily passes our last financial checkpoint. But hey, while the company looks fantastic right now, you should always verify a stock's current status on specialized screening apps like Zoya or Masafa before putting your hard-earned money in.
All right, so let's check out that engine. How strong is Micron financially, really? Just look at this number. In their last quarter, Micron posted 57% year-over-year revenue growth. I mean, that is not slow and steady. That is absolutely explosive. And it's all being driven by the insatiable demand for memory, thanks to the AI boom. Based on what they're expected to earn, Micron is trading at about 10 times earnings. To put that in perspective for you, NVIDIA is trading at 25 times earnings and AMD is at 28. You could make a very strong case that this makes Micron the cheapest pure-play AI stock on the entire market right now. And the company's financial health, it's just undeniable. In one single quarter, they generated a record $3.9 billion in free cash flow. That's cash in the bank after all the bills are paid. It just shows you how efficient they are. Okay, quick pause. If you're getting some value out of this breakdown, could you do me a small favor and just tap that like button? It really does help us reach more investors just like you. And by the way, if you want the full, detailed written report with every chart and all the numbers we're talking about, it's ready for you to download on Ko-fi. The link is the very first thing in the description. Now, what's really interesting here is how it frames the environment as a bad neighborhood. Micron might be a fantastic company all on its own, but it doesn't exist in a bubble. It lives in a fragile market, and the whole semiconductor sector is feeling the pressure. You just can't ignore that context. So let's break down that headwind a little bit. First, the overall market, the SPY, is showing real weakness. Second, the VIX, which people call Wall Street's fear gauge, is high. That means investors are nervous. And third, the semiconductor sector itself, the SMH, is in a clear downtrend. I mean, this is the storm that Micron has to sail through. So with that kind of challenging backdrop, you might be asking, why even consider this trade? Well, because the fundamental case, according to this blueprint, is built on 3 incredibly powerful pillars, and they're all pointing to a memory supercycle being driven by the massive demand from AI. All right, let's dive into that bull case. It's built on 3 powerful ideas. First, pricing power. The memory chips that Micron makes are in such high demand that prices are just surging. Second, market leadership. They are totally dominant in the specific high-end memory that AI desperately needs. And third, well, the results speak for themselves, with financials showing absolutely explosive growth. In all this tension, the strong company versus the weak market, it is all set to collide on one single day, March 18th. Catalyst collision, a moment that basically guarantees extreme volatility. It's a real make-or-break moment. So what makes this one day so critical? It's a perfect storm. You've got Micron's own earnings report, you've got a huge interest rate decision from the Federal Reserve that's going to move the entire market, and you have NVIDIA showcasing technology that actually features Micron's products. 3 massive events all on one day. Okay, let's turn to the chart because this is what sets the battleground for the trade. After a pretty big drop, the stock has found support right at its 200-day moving average. Now, for a lot of traders, this line acts as a major boundary between a long-term uptrend and a downtrend. That makes it a critical level to watch, and it's the precise area this whole plan is designed to target. So, with all that context, here is the primary game plan, and it's a conservative approach. Not chasing the price higher, but patiently waiting for it to pull back to that key support level we just saw, that 200-day moving average. And just notice the incredible precision here. This isn't about guesswork. The plan defines a very specific entry zone, an ironclad stop loss at $365 to define the exact point you're wrong, and, most importantly, it caps the total potential loss to the account at just 1.5%. This is all about taking the emotion out of it and defining your risk before the trade is ever even placed. You know, getting in is only half the battle. A professional plan needs a crystal clear exit strategy for taking profits. Look at the logic here. At the very first target to sell 40% of the position and move the stop loss to your entry price. Now, this is crucial. It turns a winning trade into a risk-free trade on the shares you have left. From there, it's just about systematically taking more profit at higher levels, making sure you get paid as the stock moves your way. But what if you don't want the stress of holding through that crazy catalyst day? Wait for all the news to come out and then trade a powerful breakout to new highs. But, and this is a big but, only if there's a surge in trading volume to confirm the move. Now here is a key element of professional planning. The bull case is given a 40% chance, the base case 35%, and the bear case 25%. This isn't about being right, it's about being prepared. So for the bull scenario, it's strong revenue and a friendly Fed. For the bear scenario, it's a miss on earnings and a tough Fed. A plan is totally useless without the discipline to follow it, right? For example, waiting 15 minutes after the market opens to avoid the initial chaos and immediately placing a hard stop loss in the system. There are no mental stops because when the pressure is high, psychology can fail you. The plan protects the trader from themselves. Now, we get to maybe the most important part of any trading plan, knowing when you're wrong and it's time to walk away. These are the kill criteria. They are non-negotiable rules that, if they're met, mean the entire trade idea is immediately terminated to protect your capital. And this right here, this is the golden rule of the entire blueprint. And it's a powerful lesson for anyone in the markets. Never, ever add to a losing position, especially when things are this volatile. You define your acceptable loss before you even enter, and if it's hit, you just accept it and move on. So let's bring it all together. This strategy is a pre-earnings pullback long. We've got the key entry, stop, and target levels all clearly defined. And the final directive is crystal clear. Be a cautious buyer on a pullback and only hold through that huge catalyst event if you have extreme conviction. And just one more reminder, if you want to see this entire analysis laid out with all the charts, the specific numbers, and my deep dive notes, the complete written report is available for you to download on Ko-fi. The link is the very first one in the description. And feel free to join our community on Twitter, Telegram, and Reddit for ongoing discussions.